explanation of the reason why you need to diversify your investment. So from the sheet below, you have iBond, BTC, DG, CMT, and Seplat. iBond is Israel bond. I got it from the investing.com website, and BTC just the bitcoins, and DGCMT is Dangote Cement from Nigeria, Africa, and Seplat as well is a petroleum company from Nigeria, Africa. So these are those choices of assets or securities that are combined together in a particular pool for an investor, for example. So what I'm trying to do is I would like to coordinate all this, the asset and the security in a particular pool, so you all could see the reason why diversification is very important, is very key when an investor wants to invest. So I'm gonna just do this again because I've done it before. So I'm trying to to bring out the returns from 2020 to 2024. So I need an average return for the last 4 years, 2020 to 2024. So this is what I'm gonna do. I need it's gonna be like the difference in the price, like the old price minus the new price over the old price. So we have this is the new minus old. So this is just the formula to get this done. You click on the enter sign and you click on this little box here, just double click on it and it's gonna bring it all straight down to so they just averagely this year return for the last 4 years. Oh, sorry, the last 5 years. So, and the key thing you need to know is that in calculating returns in Excel, average is what is used, and when you're calculating the risks, we use the standard deviation function. So for the returns, we use the average. So I'm gonna pick up all the average for the last 5 years. So this is the average return for the last 5 years, and the risk is the standard deviation. So also click on all those returns to just show me what is all. So this is, I guess it's tiny kind of. So this is the return for the last 5 years, and this is the risk for the last 5 years for iBond, that's the Israel bond. So the same thing is going to apply to BTC here. So the returns and the risk, just the same formula. So we have average, and this is just basically how investors check the risk and return of investors' securities for a particular period. So we have minus 1456 returns in BTC and 20.260 risk. So apply the same thing for DGCMT, that's Dangote Cement. Okay. This is so this is it. So I'm gonna do this same thing for Seplat. So Seplat. So do the returns first. New minus hold divided by hold. So click on this, put the brackets on the equal sign, then click on the little box here to get the whole return for the year. So still need to apply the same formula for the returns. close it. And the risk is okay. So I'll just put it a little. So yeah. So what you see right here, it's what you see right here is the return on the risks of iBond, BTC, DGCMT, and Seplat for the last 5 years. So the next thing here is the combination of all this in as one. So what I've done previously, I just put them all together here as one. So what I want to do now is I want to try and bring out the correlation. So the correlation is going to help me to bring to pinpoint which of the assets can I choose if I want to pick the first two, and which of the assets or which of the securities can I choose if I want to pick the last two. So what I need to do is, to my top bar here, I go to the data analysis. I click on data analysis and I pick on the correlation and covariance. Those are the two things I need for this stage. So the input range is the 4 stocks, and I'm going to label the rows because I need the names. So, and my output range is, let me put it here, so it's R21, so this R21, and I click on OK. So this is a correlation. So I'm going to do the same thing for the covariance as well. So covariance, go to data analysis, just the same thing here. So click on covariance, data analysis, same input range as you've used previously, and labels, output range I can use here. Then let me use here. Click on the OK side. So this is my variance. Yeah, this is my variance. Sorry, this is my covariance. Just call it covr. Yeah, this is my covariance. So the next thing in line is I want to check. Okay, now that I've seen the correlation between Seplat and Seplat is 1. Yes, ought to be 1 because it's the same company. So I don't want to stress myself by bringing out the lowest figure by the highest figure. So what I'm gonna do is I will use a format on Excel, which is the conditional formatting. So you go to Home. There is conditional formatting here. I want to apply a new row. So the new row is just to show me 3 color scale from the minimum value to the maximum value, and the midpoint is going to be 0. So the midpoint number is going to be 0. I'm going to leave the color to be the same in the midpoint, and the maximum number or the maximum value should be green. That's what I want the computer to show me. I want the function to show me. So I can see here from the correlation, the best stocks are BTC and Seplat. The 2 best stocks are BTC and Seplat. Why am I choosing this? The reason why I'm choosing this is because they are lowly correlated. And lowly correlation stocks are what we need when we are trying to invest, because the corresponding return for A will be different from the corresponding return for B. So that's why you don't need to put all your eggs in just one basket. Okay, that's the reason why we need to choose BTC and Seplat, because BTC is minus 0.275831. Sorry, BTC, yeah, BTC, minus 0.27581 to iBond, and Seplat is minus 0.867928 to BTC. So the second best stocks I don't want to call it stocks, let me just say assets, is Seplat because of the negative. Second best stock is Seplat and iBond because of the negative. So these are the second best stocks from the analysis using the correlation. So if I want to use the covariance to determine which of the best two I can go for, so I'm going to use the same rule here, 3-scale rule, lowest value, midpoint should be 0, and this should be number, apply this to green and click on OK sign. So from the covariance, the best stocks are, here are DGCMT and iBond. DGCMT and iBond. Why? Because of the negative. Yeah, because of the negative. We also have the Seplat and BTC. We also have the second best assets. Let me see, not stocks. So sorry, I'm putting stocks. So it's going to be assets. Second best assets is Seplat and BTC. Then you can see your third best assets. The third best assets is BTC and iBond. Yeah. So this is just a clear indication of diversification importance. So from the risk and return here, you can easily see that using the correlation, before I invest into any other stocks or any other assets, firstly I'll go for BTC and Seplat. This is the BTC column and this is Seplat. So irrespective of what kind of investor that you are, maybe risk averse or you're conservative with your risks or you're moderate with your risks, I prefer to have minus 1.46 return here with 20.26 risks, and also minus 2.75 return with 11.35 risks than any other place. So this is me choosing a low return of minus 1.46 to a higher risk of 20.26, and also a low return of minus 2.75% to 11.35 risks. Okay, so it's kind of blend together. So it's a blended conversion of stocks and assets together, because high risks give you high returns and low risks will give you low returns. So if I want to invest $500,000, for example, in these stocks, so I want to invest $500,000 in these stocks, I'm gonna just apportion maybe 250,000 in BTC, apportion 100,000 in Seplat, and the remaining balance in iBond and DGCMT because of my choices according to the correlation and the covariance. So before an investor invests, there's need for an analysis. There's need for a measurement of some criteria, which is what I just showed you here. This is just like the fundamental. It's not like the deep part of analysis, but it's just part of the analysis, part of your screening of your returns on risks using the correlation and the covariance. Okay, so most investors do not carry out analysis deeply. So with that, it affects investors' decisions. It affects investors' objectives. You know, the degree of risk that an investor wants to endure or wants to have depends on he or she willingness on how long they want to invest, which is a very key thing. So investors might say they want to invest $500,000 in a particular choice of assets or securities, but as a financial advisor, you might need to go through some rigorous analysis to just bring out the best type of securities that they want to use that money to invest in. And before doing that, there's need for you to bring out analysis over the years. Like you bring out history of returns or history of prices from the net, from different sources, legitimate sources they can use to show evidences of what you've actually done and how we are going to carry out all this analysis for the investors to see that, okay, there are series of analysis that have been done for you to be able to get to this point. So in my next video, I'm going to show you how an investor can tolerate risk, okay? Because there's need for risk tolerance when an investor is investing. If you don't have the risk tolerance, you might not be able to endure whatever performance is happening to your investment. So the risk tolerance is just going to show like the financial situation of the company and the financial situation of the investor. So you're going to have a deep transparent mirror between the two parties. And as well, the purpose for investments could be to grow wealth. It could be it could be a desire to just keep your money safe or to secure your money for a long time instead of putting your money in the bank, or you're just trying to take up some risks and just see how you can get your returns from the financial market. So having access to the risk capabilities of investors tends to give the investors the key reasons why taking risks is very, very important when investing. Thank you.